Hey, everybody, welcome to Coffee for Closers. Today, we're talking all about multi-year guaranteed annuities, or MYGAs, as it were called. Everything you need to know about these in such a great rising interest rate environment right now. They're becoming a little more popular. So all that and more today on Coffee for Closers. Hope you enjoy. All right. Hey, everybody, welcome to Coffee for Closers. Today is all about MYGAs, multi-year guaranteed annuities. Shorter episode today. I'm here with Rick as always. And you know, we thought this was an interesting one just because of the recent interest rate environment that we're in. These MYGAs are becoming more and more interesting. So talking about the basics of these, what it is, and maybe some of the strategic differences between that and some of the other products that are similar, or are typically used in similarity in the retirement planning space, right? So basics, fundamentals of a multi-year guaranteed annuity. This is generally, I don't know, is it 3 to 10 years? 7 years?
I would say
like
7
years, really?
Like, I guess, maybe not historically, but at least in the past, like 10, 15 years, your primary or core, like, year periods was like a 3 and 5 year.
And a 7.
7 has definitely fallen off comparatively. Obviously, short-term interest rates are a lot better than long-term interest rates right now. So 7s are almost on par with 5, so it really doesn't make the sense to waste those 2 extra years for no more interest rate.
But then also, like, the world of 7-year indexed annuities has kind of stolen away the
a lot of the business.
Of the 7-year MYGA.
So they keep trying to go like shorter and shorter. You have like a lot more like 2 years now, which isn't bad. A little 2-year MYGA. So I would say the common ones are 2-year. 3 is probably one of the most common, especially right now. Some companies have bridged the 4-year gap to say, hey, look, let's do a 4-year MYGA instead of committing to the full 5, and then 5 years. So 3 and 5 years still your biggest, but you do have some variations between the 2 and 4 space. The
idea being that you give a lump sum, just like any annuity, you give a lump sum of money, you put it in an account for design contract period, has a surrender schedule for that period, right? So if it's 3 years, it's a 3-year surrender period, 5 years, 5-year surrender period, 7-year period, whatever it might be.
Yep.
And it diminishes over time in almost every case, right? It's getting a lesser and lesser surrender charge as the years go forward, right?
Surrender charge, will just like a normal like FIA will step down.
Normal FIA. Yeah. Okay. Has a death benefit, of course, if something were to happen there. But it is a 3-5 year commitment and a guaranteed multi-year guaranteed annuity interest rate. Right. And they play some funky games with that. Like sometimes there's, a higher yield or a lower yield depending on the situation. Like, what was I seeing the other day that they were doing some first year hibbity boppity? Yeah,
some companies will.
So there's second year, third year, a little lesser returns.
A couple things to, I guess, be aware of on it, right? Like, obviously, as technology has developed, a lot of people will shop things using like a third-party system, third-party tool to see what rates will be. And
like, this one has a 5-year or 5-year 4.5% interest.
This one is a whole point or a 1.5 higher than the others. Like, that's really cool. And that's just because insurance companies have looked at it and understood that, like, hey, people are shopping this, so we'll do this. And there's a benefit to it, right? You get your first years higher than other years are, and then you get a lower on the whatever the following years after that. That's typically how it is. You have a company that's like let's say a 3-year product. They're offering you a 3% rate for all 3 years, right? Well, a company will look at it and say, hey, we'll offer 4% the first year and then 2.5 for the following 2 years, right? And try to even the math out that way. So, theoretically, it comes out the same. It really doesn't, right? Because in the third year, you're going to have more money than the first year if it's a compound product.
Yeah.
Right? And that's another thing to be considered. Is your interest rate a compound or is it simple?
Yeah.
Because, of course, that makes sense, right? You're dealing with a larger bucket of money. You got $300,000-$400,000 you're going to put in here for 3 years. A 3% simple rate versus a 3% compound rate can be a noticeable difference in growth.
Yeah.
Right.
And something to pay attention to.
So, yeah, definitely paying attention to whether that rate is just the first year intro rate or if it is the full rate for all years of the product.
Right. And the message typically had been, hey, this is a great product to store some cash away in. If you've got some sleepy money sitting out there that's really not doing anything, here's a way for you to get like old school CD type returns. CDs fell off a map. The MYGA kind of became the replacement. The problem is CD is a lot more liquid than a MYGA is, right?
Yep.
So you couldn't just use all CD money. But if it was truly a CD that was just being left alone, or it was cash sitting in a savings account that was just, sometimes you run into just outrageous amounts of money in savings accounts.
Yep.
I've seen savings accounts of $500,000.
Yep.
Not because they cashed out some other account and it's just sitting there for a little bit and then it's going to go somewhere else. It'd been years.
Just to have it for safety.
Safety, yeah. Like that's what they had been taught, or they were just kind of, new school mattress under the, I need
had enough money in the market and didn't want to put it in the market. So where do I put it? I don't know. I'm just going to leave it in the bank account, right?
Yeah, right.
Yep.
And sometimes it's just like, I don't know. I just like seeing it. I'm like, okay.
All right, fair enough.
Okay.
I understand that,
But, you can see it over here in this account where it is bringing some value more than, say, a CD interest rate, but also bringing more value than your market exposed assets because of the downside protection and not as much commitment like an FIA might have. And so it becomes a nice, useful tool for retirement planners to, take some chunk of money that we're just not sure what we're exactly going to need this for. But here, and a lot of times these end up being post-tax dollars, right? Non-qualified assets. But if they are qualified, there's, obviously qualified multi-year guarantee annuity options. And it's a nice little buffer. I've got guys that do this repeatedly. Hey, look, if we're going to keep it here, this is a 3-year commitment. At the end of the 3 years, we'll decide if we want to put it to work for us or keep it in something similar. And for a lot of advisors, it just wasn't that interesting because these rates were like at 2%
for a 5-year or something like that,
But now it's like, wow, I could guarantee myself 4.5%, or guarantee my client 4.5% for 5 years, or for 3 years, whatever it might be, in a place where the market's super volatile, or expecting a huge cliff, or a recession, or whatever, and inflation's kind of getting at it. It's like, here's a really great way for us to just guarantee things. And it's no different than folks putting money in the guaranteed bucket of the FIA, right? And people are doing that, but they're getting much less returns. Almost the kind of returns that they were seeing at MYGAs a year or so ago, or 2 years ago.
Yeah, it definitely depends on the product, but, it's a thought process, right? It's like, if I'm going to, at least, let's say in an FIA, right, I'm surely probably more than likely going to get a 0 this year. A lot of people are saying we're going to go into a place of stagflation. Who knows, right? Maybe we could have 2 down years, right? So if you count a 0 this year, 0 next year, and maybe a 8, 10, something like that in the third following year, then you've evened out with an FIA versus a MYGA, right? You've gotten a 3.5, 3.5, 3.5, put you at 11, right? A 0, 0, and an 8, you're still up, right? You're doing much better than the MYGA, right? And of course, it's like you're trading the risk, which was always the concept with an FIA, was, hey, look, we're taking a little bit of risk, and just in the sense that, will this perform or do we get a 0, right? Obviously, you're not going to lose money, but we're going to get performance versus the guarantee option. I think it makes a lot of sense now. And of course, you do have the fixed bucket.
You do also see like less money though. Like, again, you're going to put much less money in a product like a MYGA than you would in an FIA, and because of that risk, right? It's like, I'm not going to put so much money at risk of not getting return. The FIA offers me a much better chance of getting a better return long term, and therefore I dump more money, even though it's a longer commitment.
Yes.
I'm going to put more money there because there's more ability for it to do, the safe downside protection, but also give me that upside. So you see a lot of folks write a lot of the 10-year stuff, not because it's like, oh yeah, it's just a 10-year product and they get paid more or whatever. It does make more sense for retirees in the long run. But the MYGA, now bridging above that 4% mark, starts to say, okay, well, we've got a smaller bit of money that we could potentially put at a less
fixed guaranteed,
no risk rate.
I think something
now,
too with like the MYGAs is obviously with it getting more competitive. Obviously, that always breeds something better for the client. A lot of the rules, that was always the downside to MYGAs, like you mentioned with CDs, right? CDs are a lot more liquid. You can get money out of it. You have access to it. Where a lot of the MYGAs, at least 10 years ago, 5 years ago, it was like, you're putting this money in for 3 years and you're not going to touch it for 3 years. Where a lot of companies have become a lot more competitive, where you have as low as sometimes the interest you can pull out, right? So if you have a 3-year product, you're getting a 3.5% rate. You can withdraw 3.5% off of it, right? At least you get your principal out. You've pulled out again, 11 or 10.5% over the 3-year period, right? Some of them go as high as like a fixed index annuity where you have a 10% withdrawal you can do, which is crazy to say, hey, look, I can put my money in here. I'll get a guaranteed 3.5 to 4% rate. And if I need the liquidity, at least I have the option to. And that's been a really cool change to see over the past few years. People adjusting to that and fixing some of the liquidity issue.
Again, but that's just, again, so with the advantages that we're just talking about with FIAs getting more competitive and them making these products more ideal for the consumer, less and less people wrote MYGAs. And now MYGAs are having that same kind of eureka moment where they're like, well, shoot, we need to sell more MYGAs. How do we make these a little more accessible? Is it that we could just drop the interest rate by 10 basis points and make this product more accessible as far as liquidity goes? And that's kind of what you've seen. You know, you don't see the 10 basis points less that they're hiding now because they've, increased the rates so much. But some of the drops in interest rates with MYGAs over the last, 5 years potentially was because they were trying to price in better features, you know. And so anyway, you've seen this kind of this evolution coming with MYGAs that's been good, and I think advisors are again in a place where our typical thought process about bonds and banks and all of these different products that have been traditionally the foundations of somebody's core holdings in retirement, they're shifting to, okay, well, there's really only one person that can really do this. It's an insurance company. And the cost of that is a little bit of liquidity. So all of the assets that potentially don't need to be very liquid are best suited for a retiree. And I'm not going to make too much of a generalization, but generally speaking, for retirees, assets that don't need to be liquid probably are best suited in some sort of insurance product.
Yeah, absolutely. If you're investing a good portion of your money into 30 or 20-year bonds, that money is not supposed to be liquid, right? You're supposed to be leaving that in there.
Yes.
Those things are going to hell in a handbasket right now, so why wouldn't you side with doing a 3-year fixed rate product?
Right.
And, moving that until things calm back down with interest rates, right?
Right.
You're already planning for that money to be illiquid. It's already illiquid.
There's confusion in the interest rate environment. We have no idea what's going on with it. If you have safe money strategies out there, that safe money strategies need to be with an insurance company.
Yep.
Right.
That's fixed and locked in.
And so what do I do with the smaller buckets that I don't want a 10-year commitment on? The MYGA is the best choice.
Absolutely. Yeah.
And SPIAs are silly.
Yeah.
Unless a bucket planning
like a laddering structure,
right? Some sort of laddering strategy.
Yeah, and those are becoming a little bit more comparative too with interest rates rising, where that was, for the past, 4 or 5 years, it's just been unbearable. It's like, you might as well just left it in a bank account and spent it and at least had the, the money still in your hands, right? Yeah. It's like you're going to get a 1% growth rate on it every year. It almost made no sense to do it. So
SPIAs are getting a little better though.
But they're still
a huge risk to take for somebody.
Yeah.
So
better structuring and income products, but
right. Anyway, that's everything you need to know about MYGAs. It's not an overly complicated product. You got 3, 5, 7 years. You got 2, 4, 6-year strategies. There's all kinds of MYGAs out there. Guaranteed interest rates, non-qual or qualified monies, does not matter. And then, pretty simple. Get an interest rate going. It's either simple or compound interest. And then you decide what you want to do at the end of that surrender period or at the contract period.
Re-roll it, move it to something else.
That's it. Anyway, if you any more questions about MYGAs or anything like that, feel free to ask. Mention in the comments. If you haven't already, don't forget to subscribe. Give us a like. Always helps. We'll see you next time on Coffee Closers. Take care.